Let's talk about what exactly drove yesterday's trading action and what made it possibly one that you could have legs or have more endurance with over the medium term.
Well, it started over the weekend, central bank after central bank coming out and saying they were ready to step in as needed. I don't think it was a surprise, but at some point the sentiment or investor sentiment needed to hear this reassuring message. You had the G7, which looks to be maybe disappointing a bit in terms of what kind of message they're sending, but they were coming together. And at some point, markets thinking, OK, we're going to have a coordinated response. We're going to have a lot of support, whether it's fiscal and monetary, wherever it's possible, and maybe even more than what was possibly expected. And that's what you see in markets. You also eventually had to snap that very long and very violent losing streak. Now, it doesn't mean it's all clear. We'll see how it goes. It wouldn't be a surprise to have a couple days up and then to have a few more concerns come back. You still are going to have questions on growth as this outbreak spreads through Europe and the U.S., and we're still trying to assess the economic impact. But having that backstop, having the central banks and the major governments as this support will always be helpful.
All right, so Kari, it's interesting what Esty brings up here, because she's saying that there may not be yet a bottom in place. However, that hasn't stopped asset managers like yourself from putting money to work. So were you, in the course of the past few days, buying on that weakness? And if so, where are you putting money to work?
Yeah, exactly. Well, we looked at Friday, where the market had that sharp decline and then ended the day in a much better position, less than 1% down, as bargain basement opportunity. And so we put together a list of what we thought might recover quickly and was very cheap, including Facebook, Amazon, PayPal, Salesforce, names that had been strong names for us over the past couple of years. We own them. We added to those positions. They were all down sharply. And we imagine that this economy will recover. This virus
Kari,
is going to.
Was it just technology, though? Because all of those things, I think payment technology like PayPal, I think large cap, mega cap social media like Facebook, these are names that have been darlings for a while. Was it only tech and comm services that was on your shopping list? Was there anything else out there that you thought was attractive?
Yes. We also bought some BABA, which is similar, but it's a Chinese company. We bought some PSX, which is Phillips 66, an energy refiner. We bought Remax, which is a real estate company. It's a real estate agency. And we bought one biotech stock. We bought a few names. Evolus is the name that we thought were extremely attractively priced, that the market would start to come back to at the multiple that the market was trading at on Friday, which was about 16 times next year's earnings. And that's very, very low growth earnings. Nothing this year, some next year. We thought this is an opportunity, such as December of 2018, where the market crashed.
So, Esty, Kari brings up a great point about this. There have been calls about the valuation of the markets for quite some time now. They are overvalued. The markets can't keep going higher. They are statistically overbought. So on this kind of a pullback, is it more attractive to you? And if so, what types of companies and industries go on your shopping list, Esty?
Absolutely. Valuations were high. We thought that they could continue to go higher, especially as earnings growth for this year was supposed to be a bit better. And we probably will get back to something like that. I completely agree. I don't think we're going to see a recession in the U.S. We're pretty constructive about the medium term. So valuations are much more attractive today. There's a lot of areas, including technology, that are going to be appealing. I think some other sectors might take a bit longer, such as energy, where you're really going to have a bit more confidence in global growth that needs to come back before those are working. But in general, we also tend to look a lot geographically, and we still favor the U.S. Europe should benefit at some point, but it is more exposed to Chinese growth, and you could see more of an impact there on earnings and on growth for the old continent. So a bit of preferences there, but definitely more positive to go back in, and maybe one of the reasons why we had a better performance yesterday as well.
So, Esty, before we let you go here, How much of the market moves these days in this environment are going to be predicated on financial ministers and central bankers getting some kind of a coordinated response together? Is that necessary for the markets to become more constructive over the near to medium term?
I think markets needed to hear you had that backstop, you had that floor, and most of what the central bankers were trying to do was to bring back some stability to the markets. If you think about it, cutting rates is not going to make, at least in the next couple of weeks, that big of an impact on the economy given what is concerning markets, but it does really help investor sentiment. And at some point, you're going to have investors who think, oh, these valuations are better, the levels are more attractive, how long do I want to stay out of this? Am I worried I'm going to miss out when this bounces? And that's the question already after yesterday. So you needed to hear it and to maybe put a stop to the skid, but it'll probably take a little bit more to have a more sustainable move upwards.
All right, Kari, the last word to you here. How important is the coordinated response? Is it necessary from central bankers to make this thing last?
It's a good thing to have. Remember, it's the coronavirus that was worrying investors in the market. So if the coronavirus appears to be receding in China, the lowest number of cases today we've had in a long time, that's what the market is going to want to hear today.